Hey guys, and welcome to my video on estimated tax payments. So I always was curious, why would we pay estimated tax payments? Why we don't just deposit, like let's say deposit the money to the checking account and get that interest rate in the end of the year? So I kind of wanted to investigate that. So in this video, you'll get the answer if you actually, what makes more sense, paying estimated tax payments or just deposit your money to the bank and just use that interest income to pay the penalties. So let's dive in and get the truth. So interest rate for quarterly estimated payments is set every quarter by IRS by adding 3% to federal short-term rate. So for example, in 2024, the short-term rate, I'm so sorry, it's just really confusing sometimes, it's 5%. So we added 3% to 5%, and that's how we came up to this interest rate. It's 8%. I mean, obviously, IRS, we don't have to calculate it. We just go to IRS website, and they provide it to us for 2024 for each quarter. And also, we can take a look and see how much they were like a previous year. So for example, only 2 years ago, so we jumped from 5% as a penalty on estimated payments to 8% now. So it's like a huge jump. That's why like now it makes, I guess, even more sense to pay estimated payments than before. So usually what IRS does, it just takes your tax liability. Let's say 90% of your prior year tax liability is like $20,000. So this is your estimated tax bill that will be in the end of the year. So they multiply that by 8%, and supposedly this will be your penalty by end of the year. I mean, it's not calculating exactly like that, and that's why I want to go over this form that calculate penalties and kind of explain you how much it actually will be. So it will be less. And the reason why, because you pay 8% on each quarter till the end of the year. So let's say Q1 you will pay more, and then Q2 you'll pay less, and then Q4 you pay much less than 8%. But let me show you the numbers because it's really confusing to explain that without showing actual numbers. Let's go. All right, guys. So now second part, estimated tax penalties, how they calculated. So we have this number, and it pretty much tells us it's in worksheet calculations. It won't be here, it's going to be separately. So let's take a look how it was calculated. So here's our worksheet to calculate the penalty, and let me walk you through it and explain. So here's our estimated tax payments. So this is our total liability for the year divided by 4, right? 4 equal amounts. Then all these parts, and I made an Excel schedule. So I'll go to Excel schedule because it's easier for me to explain by showing you the formula. But in general, those are days since it's calculated for a period between April 16 to June 30th. So it's calculating how many days it was by this specific day, right? So for example, in this column, it will be from June 15 to June 30th, which is 15 days. In this column, it will be from July 1st to June 30th, which is 92 days. But then from when? From September 15 to September 30th will be 15 days. So that's kind of calculation. Let me show you Excel because I think this is much better. So this is exactly the same schedule, but it has formulas, so it's easier to explain. So let me explain you the first periods. In blue, those are interest rates for each period. So for example, let's go through first one. So we'll calculate number of days between what? It basically says for the first period, so we do it, before. Oh, this is a little bit bizarre. But anyways, this is from June 15 to June 30th. And this is for all this first period. So it's actually, it's just a little bit not straightforward, but it's for a full period, 76 days. So it will be 2.5 months from April 16 to June 30th, right? So this is amount. And we calculate, then we do this number that is actually will be multiplied by. So this number is number of days
divided by 365. So we calculated 76 days and we calculated 15 days, and here we just divided by 365. The interest rates are the short-term federal interest rates are posted on IRS website. So for 2023, they were 7% for first 2 quarters, and then eventually they increased to 8% for last 2 quarters. And for 2024, they will be 8% for first 2 quarters, and who knows, they might increase to 9% or stay at 8% for the rest. So that's kind of like, so then the calculation would be that amount multiplied by this whatever number we try to include number of days and multiply by 7%. So let's say on 4/15, on this first rate period, we pay 76%. That will be our penalty for this amount. Then we calculate second period. So second periods, it will be like much higher. Not much higher. It will be also from July to September 30th. So it's 92 days. And that will be also, we divide that number by 365 and multiply by 6%. And this will be our penalty for that period. In any case, and we do it for each of those rate periods, 1, 2, 3, 4. Right? And the rate periods end June 30th, September 30th, December 31st, and then April 15th. So for this first Q1 payment, for a full year not paying that Q1 estimate will make the total penalty of $397, and that will consist of those three amounts. And I did the same calculation for each quarter, right? So it's the same. This one will be smaller. And then this one will be even smaller for Q3. And then Q4, that's super easy. So Q4 will calculate the number of days from January 1st, 2024 to April 15, 2024. That will be 91 days. Then we'll divide that number of days by 365. And then that number multiplied by 8%, that will be our penalty. So for not paying Q4 estimate tax payments, we only pay $100, right? Anyways, so total of those four amount will be $1,081, and I'll compare to the software right now. So this is the total penalty we pay. And if you compare percentage-wise for each quarter, so we get almost 8% for Q1, 6.3% for Q2, 4.6% for Q3, and for Q4 we'll get only $199. What I'm trying to tell you this, I'm sorry, like why she's explaining this, right? So what I'm trying to say, like 8% is actual rate, or like let's say 7%. But if you multiplied our total required payments by 0.8%, that will be like a higher amount, right? So this is what, if you think we'll just multiply the total tax payments liability by 8% and this will be our penalty, it doesn't work like this. So it works more like gradually decreasing, because the amount from a due date for Q4 to actually when it's supposed to pay, it's not as many days as for Q1, right? So obviously for Q1 we'll actually pay almost 8%, or average between 7 and 8%, but then for Q3 and Q4 and we'll pay much less. Okay, so this is how the penalties are calculated. I hope I didn't confuse you too much. Let's just take a look at the tax form one more time. Okay, so here we have those 1,083, that 82 that agrees to my Excel schedule, but that's kind of how they did it. They just added up all these numbers and they did exactly the same calculation. So it's smaller. For Q4 payments, it's only 105. For Q3, it's summary of those three numbers. Then for Q2 and Q1, we add those numbers. I hope I didn't lose you, and thank you. Let's move on.
Alrighty, so let's talk about what you actually want to find out is what makes more sense, to make those estimated quarterly payments and not to pay penalty at the end of the year, or not making them, and let's say deposit money to the checking account and get that interest income. So, in my opinion, I think if you compare both numbers from today's lesson, from today's video, we can see that if on tax liability of 20,000 that we need to pay in the end of the year, if we don't make estimated tax payment, in the end of the year, we'll have to pay a penalty, and the penalty will be around $1,000, right? That's something we agreed on. So now let's compare how much is the interest rate on deposits for a checking account nowadays. So it's around 4 or 5%. So if you multiply that 20,000 that you decided not to pay tax liabilities and just deposit to the just checking account to get interest, so you'll get the 20,000 multiplied by what? By 4 or 5%. So you'll get the same $1,000 in the end of the year that will cover your penalties. So, but something I want to mention before I jump into conclusions. So when you get interest income is taxable. So that would be your additional income, right? So those $1,000 from checking account as interest income will add up to your taxable income, and you will pay, like, let's say 25% tax. On the other hand, if you pay and then you pay penalties, and penalties are not tax deductible. So that's just kind of like an issue that I can see there. But in the end of the day, if it's a business owner, if your client is deciding between paying $20,000 a year for estimated tax payments, or doing some kind of expansions for their business or something else, or just investing them into just regular checking account, I would recommend not to pay estimated tax payments. I'm sorry, tax professionals, I know it's our job to calculate and do all this kind of stuff, but economically, I mean, honestly, it doesn't make sense to me. It's not a big difference, it's not a big amount. And if I was a business owner, I would invest it into, like, whatever, financial instruments or your business or whatever. In any case, I hope this video was helpful. I really hope you're not disappointed by whatever my ending or my conclusions. And thank you so much. See you in the next video. If you're interested and you like how I teach or how I explain, I also sell online courses. I also do tax preparation outsourcing. So I help your company to do tax preparation. Let's stay in touch, and thank you so much. Bye-bye.